I'm so pumped you decided to click on this video because today we're going to be talking about a really important money topic. Why you shouldn't keep all your cash in the bank. I know, crazy, right? We've always been taught to save our money in a traditional savings account to let it grow. But what if I told you that banks might just be duping us? I can see the skepticism on your faces, so let me explain. I recently started diving into the world of personal finance and came across this guy named Robert Kiyosaki. He's a famous entrepreneur and author who believes that the traditional path to wealth we've been sold, get a stable job, save money, retire comfortably, is actually setting us up to fail. Instead, Robert breaks down our money-making potential into something he calls the cash flow quadrant. There's E for employee, S for self-employed, B for big business owner, and I for investor. Most of us start out in the E quadrant, trading our time for money. But we're limited in how much wealth we can accumulate just by working for someone else. The turning point is to shift from being an employee or self-employed to owning a business or becoming an investor. That's when your income and assets can really start to grow exponentially rather than linearly. But merely switching quadrants isn't enough. Robert identified 4 asset classes that the ultra-rich use to build and preserve their wealth. 1. Owning a business. 2. Investing in real estate. 3. Stocks, bonds, and other paper assets. 4. Commodities like gold and silver. He calls these the 4 main wealth vehicles that can drive you towards financial freedom. First up, the power of business ownership. Entrepreneurs like Jeff Bezos and Elon Musk have built multi-billion-dollar empires by creating innovative businesses. Businesses can snowball wealth over time through leveraging systems, teams, and scalability. For example, a bakery owner could create processes to streamline operations, hire employees, and open multiple locations that run semi-autonomously even without the owner being there. This allows the initial effort put in to continue compounding as the business grows. Investing in existing companies can also lead to wealth. To evaluate starting your own business, identify your areas of expertise, passion, or experience, and determine what skills, services, or products you can offer with a competitive edge. Validate customer demand by conducting surveys, interviewing potential customers, and looking for Facebook groups dedicated to the topic. If the business looks promising, break things down into an initial minimum viable product, which is the most bare-bones prototype version of your product or service that early customers can trial while requiring minimal effort for you up front. Sharing your business with systems to multiply your time and impact is crucial for freeing up your most precious asset, time. Tools like Fiverr, Upwork, and TaskRabbit make it easy to outsource repetitive tasks for cheap. As your business model is proven, bring on team members or contractors to replicate what you were doing manually to rapidly grow. This leverage effect is key for freeing up your most precious asset, time. To unlock exponential growth, refine your business systems, team, and operations enough to franchise or license your model. Franchising allows business owners to open new locations leveraging an existing company's brand and processes for a licensing fee, taking companies like McDonald's from regional players to having locations globally generating billions without requiring huge capital investments. Here are some key questions to ask when evaluating a business idea. 1. What skills or offerings are uniquely positioned for where there is clear customer demand? 2. How can you validate your concept quickly with a minimum viable product before overbuilding? 3. What systems can be implemented to scale throughput and impact exponentially? 4. At what stage does franchising or licensing make sense to accelerate growth through leveraged channels? Okay, let's move on to our next wealth vehicle. Real estate investing has become a popular investment strategy for many wealthy individuals, including Donald Trump and Barbara Corcoran. This asset class can generate substantial cash flow through rentals and appreciate in value over decades, with tax perks like depreciation being a key factor in reducing tax burdens. For example, if you buy a duplex for $300,000 with a $240,000 mortgage at 5% interest and rent out each unit for $1,500 a month, your monthly mortgage payments pay off the property's rent and provide an extra $500 cash flow per month. In 5 years, if the property value grows to $360,000, your equity goes from $60,000 to $120,000, doubling your net worth just through appreciation. However, real estate investing comes with challenges such as fixing toilets, dealing with bad tenants, and large mortgage payments. Robert emphasizes the importance of OPM, other people's money, and positive cash flow, which focus on rental income exceeding expenses like mortgage, taxes, and maintenance each month. Long-term generational wealth relies on consistent cash flow to hold assets indefinitely, rather than relying on market timing. Multifamily units offer economies of scale with costs and operational overhead, as well as higher rental density and tax advantages. House hacking, REITs, publicly traded real estate funds, crowdfunding sites, and hard money lending are some lower commitment options to participate in real estate wealth creation. In summary, real estate investing offers numerous opportunities for wealth creation. By strategically investing in real estate, you can enjoy the potential for significant wealth growth. Paper assets, such as stocks, bonds, mutual funds, savings accounts, and certificate of deposits, are considered the riskiest wealth vehicles due to their established and regulated nature. However, they do not build wealth as much over time due to inflation and economic cycles. Savings accounts earn interest rates that rarely outpace inflation, meaning the money doesn't gain much purchasing power. In economic downturns, the stock market declines, impacting billions in wealth. For the average person trying to grow their money, paper assets carry real risks in the form of volatility and loss of value to inflation over time. While stocks and bonds can be a part of a balanced portfolio, diversification is crucial. Mutual funds and ETFs can help mitigate individual company risk, while index funds track entire markets. Bonds add stability but can lose value when interest rates rise, and short-term bonds like 3 months to 5 years provide liquidity with less rate sensitivity. Government and municipal bonds are safest for first-time bond investors. If you'd like to build a monster ETF portfolio, do check out my other video on building an ETF monster portfolio in the link above and in the description down below. Savings accounts play a key role as stable holdings for emergency funds, tuition savings, or short-term goals. However, paper assets have limitations, as they don't actually help money grow, but rather lend it out at higher rates for their own profit. While paper assets serve a role, they won't lead to exponential wealth creation. Higher return alternatives are available once solid financial foundations are built. Gold and silver are valuable assets that hold intrinsic value and act as a hedge against inflation and economic uncertainty. They are often considered God's money due to their limited supply and the fact that they cannot be printed like fiat currency. When paper assets decline or collapse in crashes, gold prices often rise sharply, providing an anchor for wealth protection during periods of inflation or volatility. Examples of gold and silver's long-term value worth understanding include gold's peak in 1985 at $300 an ounce, which exceeded $2,000 an ounce before pulling back, and silver's peak in 1980 at $50 an ounce due to desperate stockpiling during financial volatility. These examples demonstrate the defensive nature of gold and silver, even with the development of complex financial instruments. When markets crashed during COVID fears in March 2020, investor money rotated back into precious metals, demonstrating their defensive nature. Physical possession of coins, jewelry, or bars requires secure storage, but paper proxies like ETFs and mining stocks offer exposure to metals upside. Physical possession carries lower counterparty risks compared to futures, funds, and other derivative plays. To maximize upside potential per dollar invested, consider silver over gold initially. Many gold bugs speculate that the gold-to-silver ratio could compress back to historical norms, driving more arbitrage trading between the two metals. There you have it, Robert Kiyosaki's 4 core wealth vehicles: business ownership, real estate, paper assets, and commodities like gold and silver. These are the main wealth vehicles driving financial freedom. If you feel the same way and want your money to work harder for you, definitely check out Rich Dad, Poor Dad, and Robert Kiyosaki's other books. And let me know which wealth vehicle resonates most with you in the comments. If you enjoyed this video, do like and share this video so that more people will learn about the 4 wealth building assets. Check out this playlist of my top 10 videos for personal development, and I'll see you in the next video. Take care.